Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Welcome back to the Grow Your Wealthy Mindset podcast. Today, we're talking about something every physician loves to hate, paying taxes. My favorite podcast is Freakonomics. It's the first podcast I ever binged, and I've listened to every single episode, starting with episode 1. I even got the chance to meet Stephen Dubner in person when he came to Cleveland and did a program with the Cleveland mayor. If you've never listened to the podcast, Dubner has an incredible way of looking at what he says is the hidden side of everything. In April, Freakonomics reran an episode titled 10 Myths About the U.S. Tax System. This is an episode that originally aired in 2025. It featured Jessica Riedl, a budget and tax fellow at the Brookings Institute. Riedl is consistently named by Washingtonian Magazine as one of the most influential economic policy professionals in Washington, D.C. I listened to this episode twice when it first came out, and I re-listened to it again last week. Why? Because as physicians, we have a very complicated relationship with taxes. We work incredibly hard for our income, and when we see the massive chunk missing from our paychecks, it starts to feel personal. I can't tell you how many times I scrolled through physician Facebook groups and seen the same post. Someone asking how they can lower their tax bill. There's a lot of, shall we say, locker room talk in medicine about taxes. Someone heard from a guy who heard from a guy that you can write off a G-Wagon or that the rich don't pay anything. But here's the cold, hard truth for most of us. If you are a W-2 wage earner, your options are limited. The tax code isn't a list of punishments, it's a list of incentives. The government wants people to build houses and provide housing, so they give tax breaks for real estate, including rental housing. They want people to create jobs, so they favor business owners. As a W-2 physician, you aren't creating jobs in the eyes of the IRS. You are the labor. We often hear the famous Warren Buffett line, where he claims that he pays a lower tax rate than his secretary. We hear that and think, if a billionaire pays less than his secretary, then surely I, as a hardworking doctor, should be able to find some way to pay less taxes. There's got to be a loophole that includes me somewhere. But this is where Jessica Riedl's research comes to burst our bubble and actually give us some perspective. Let's break down the Buffett situation because it's the root of so much tax envy. Buffett's income doesn't come from his salary, it comes from capital gains. Think of this. If you buy a house for $500,000 and it appreciates to $1 million, then you are $500,000 richer on paper. But the IRS doesn't send you a bill for that $500,000 gain until you sell the house. This is what's called unrealized wealth. When Buffett does sell, he is taxed at the capital gains rate, which is currently around 20% for high earners, and that's significantly lower than the 37% top marginal rate that physicians may be paying. However, Riedl makes a crucial point in the podcast. She says, if you look at the actual data, even if you take into account capital gains taxes, high earners pay a significantly higher rate than low earners. As physicians, our wealth is mostly what's called earned income. We trade hours for dollars. This is the most heavily taxed form of wealth. If we want to pay Buffett rates for our taxes, then we have to move from being earners to being owners. This is actually what Robert Kiyosaki of Rich Dad Poor Dad fame stresses when he talks about moving from the right side of the quadrant to the left side of the quadrant, going from being employees and self-employed to being investors and business owners. This leads us to myth number 3, the middle class pays higher tax rates than the rich. The data shows that the U.S. federal tax system is remarkably progressive. Within income taxes, the lowest earning 40% actually pay a negative rate due to all the tax credits. The median earning family pays an effective rate of just 2%. Meanwhile, the top 1% pay an average of 21.5% or even higher. Now, let's look at this globally, because this is where it gets interesting. The US has the most progressive income and payroll tax system of any OECD nation. That's a group of 38 developed countries like Canada, Japan, and most of Europe. We often hear, we should be more like Europe. But in Europe, the tax burden is spread much more evenly. While they tax the rich at similar rates to the United States, they tax their middle class far more heavily than in the United States. Most of these countries also have a value-added tax, abbreviated VAT. Basically, it's a national sales tax of 15 to 25% on almost everything. In the US, the top 20% of earners pay just under $2 trillion in income taxes in 2024. The bottom 60%, by contrast, paid a collective income tax of negative $92 billion. As physicians, we are the ones keeping the lights on for the federal government. I know many doctors don't feel rich. There are doctors out there with $300,000 in student loan debt and living in high cost of living metropolitan areas. But compared to the population, we actually are the rich. Look at the 2025 Medscape data, which I went into detail during last week's episode. The average physician salary is $356,000 in 2025. The lowest paid specialty, pediatric, averages $266,000. According to Investopedia, to be in the top 5% of earners in the United States, you only need to make about $242,000. This means even a full-time pediatrician is in the top 5% of U.S. earners. When politicians talk about taxing the rich, they're talking about us. The scary part, the taxes we collect aren't even enough to cover the deficit. This brings us to Riedl's myth number 7, which is taxing millionaires and corporations can eliminate the deficit. She did the math, and it's staggering. As of 2025, there are about 902 billionaires in the United States. If the government literally seized every single penny they owned, every private jet, every share of stock, every mansion, every yacht, and then sold it at full market value, it would still only fund the federal government for 8 months. After 8 months, all that money would be gone. The billionaires would be broke, and we would still have a deficit. Even if we taxed every person making over $1 million at a 100% tax rate, it still wouldn't balance the long-term budget. Why does this matter to you? Because it means in the future, if the government wants to close the deficit, they can't just go after the billionaires, the 900 people at the top. They will eventually have to tax the middle class more like Europe does. So, what's the takeaway? As much as we pay now, we are likely to pay more in the future. This is why I prioritize contributing to both traditional tax retirement accounts and Roth retirement accounts. Even when I'm in the 24% bracket, I've elected to contribute to a Roth 401k instead of a traditional one. Many people say to take the tax break now, but I'm looking at the national debt and these myths that Jessica Riedl dispelled. I suspect that tax rates are really at a historic low right now. By paying the tax now in a Roth, I'm protecting my future self from whatever higher rates the government creates 20 years from now. Plus, contributing post-tax money allows you to effectively stuff more value into the account. A $23,000 Roth contribution is worth much more than a $23,000 traditional contribution because the government already took their cut out of the Roth contribution. If you want to lower your tax burden, stop looking for loopholes and start changing the nature of your income. What you want to do is move your W-2 income into appreciating assets. That is the key to building true wealth. It's buying assets and holding the assets that appreciate, as well as give you positive cash flow. I'll put the link for Jessica Riedl's article and the Freakonomics podcast in the show notes. Knowledge is power. And in this case, knowledge may save you from a lot of frustration next April. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. Keep growing, and I'll be back next week with another episode. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.